morning everyone, this is Amit Pabari, founder and managing director of CR Forex. Rupee, after moving in a straight line for last 6 months, that is moving higher and higher, or we can say that Rupee got weaker against the dollar. Now there is a tug of war going between positive factors and negative factors, and market is confused whether the Rupee will get stronger or weaker. In today's presentation, let us analyze both the factors. Let us understand what are the positive factors which are affecting Rupee. The first positive factor is that, strange, but the fact is that when Nifty was trading close to 16,000 to 16,500, FIIs have been selling. Now when Nifty is trading close to 18,000, they have started coming back in the market, and in last 4 trading session they have invested close to 12,800 crore. If the trend continues, it can have a positive impact on dollar rupee pair. The second important factor is that few important economic data of India are coming much better than other economies like UK and Europe. That is, manufacturing PMI and service PMI both came at 55 and above level. So Asia's 2 biggest economy, which is China and Japan, both currencies have started showing some kind of recovery in last week. Chinese currencies appreciated from 7.30 to 7.18 level in a one single day, and similar trend we have seen in Japanese yen also. If this 3 positive factor continues, then we might see dollar rupee pair breaking a critical level of 81.80 and moving towards 81 to 81.20 kind of a level. Now let us analyze what is the negative factor for dollar rupee pair. The first negative factor is that in last 1 week, WTI crude has moved up by 11%, and we were talking about that after US midterm election we can further see WTI crude price moving higher. If that happens, if the crude oil price move towards 105 kind of level, then it will have a negative impact on our trade deficit. Second important data point is that 2-year treasury yield and 10-year US treasury yield are showing a momentum that the Fed is going to continue to increase interest rate at a faster pace. If that happens, then a dollar index will move towards 114 and 117 level. If dollar index move higher, then it will have a negative impact on all emerging market currencies. Third important point is that our trade deficit continues to be higher. If crude oil moves above 100, it will definitely have more pressure on our trade deficit. Now let us discuss what is the outlook for dollar rupee pair. You must be thinking that he is having positive factors also and negative factors, but honestly speaking, the way it was very difficult to predict which team will qualify for semi-final in T20 World Cup, in a similar way it is getting difficult to predict rupee move for the next 8 to 10 trading session. For the coming days, 81.80 to 82.20 will act as a very strong support for the pair. If by chance the pair breaks that level, then the pair can move towards 81.20 to 81 levels. If the pair is not breaking that level, then the pair can continue to trade between 82 to 82.60 for the coming days. Like I always say, if there is a confusion in the view, we have to plan our hedges well. Now let us discuss strategy for exporters and importers, starting with thin margin exporters like agri exporter or chemical exporter. Last week we suggested them that if anyone is having costing between 82.20 to 82.40 kind of level, they should cover 100% on a back-to-back basis. For the coming days also, any costing above 82, they should just cover back-to-back. On Wednesday video, we said that by chance anyone who has taken costing close to 83 level, then 50% of that they should cover near 82.80 level. And exactly on Thursday we have seen 82.89 ka high. And for the remaining 50%, we suggested them that they should keep a stop loss of 82.20 and 81.80. If their stop loss is triggered, then we will suggest them to just go and cover that. Because if 81.80 is broken, then there are chances that we can move towards 81.20 kind of a level. Now let us discuss strategy for thick margin exporters. Thick margin exporters like textile exporter or engineering exporters. Last time we suggested them that they have to maintain a hedge ratio between 40 to 45%, and to participate they can participate between 80 to 65 to 80 to 80 kind of a level. I hope that all thick margin exporters must have participated at those level. Now for the coming days they have to see whether 8180 is breaking or not. If 8180 is breaking, then they have to increase their hedge ratio further. Now let us discuss strategy for importers. Volatility is at highest level and forward premiums are at multi-year lowest level. In that case scenario, importers should ideally hedge for next 30 to 45 days import payment. On Monday morning, they have to see that whether the pair is taking support between 8180 to 82 levels or not. If the pair is taking support at those levels, then simply they have to cover 50% of their import payment for next 30 to 45 days. If 8180 is broken out, then they can target 8150 or 8120 also to cover their imports. Now let us discuss trading ideas for coming days. Sell Euro USD between 0.9950 to parity. Target है 0.9750. Stop loss है 1.0050. With this I will end my today's presentation. जय हिंद, नमस्कार, फिर मिलेंगे. Thank you.